Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss yield spreads. Also take a look at, did the yield curve get it wrong? Also dive into trustee versus power of attorney, and a look at the Plan Solutions Incorporated office bulletin board. All right, well, let's dive right in here, and let's start with the yield spreads. Interest rates, we've been talking about it. I mean, very, very important. So interest rates are basically the price of money over a given period of time. We have discussed this on multiple occasions, but what are we seeing as far as yield spreads going on right now, and how interest rates play a very important role in financial analysts and how the cost of money as it continues to shift has an impact that maybe many of us ignore at times?
Yeah, I mean, interest rates get a lot of attention, and rightly so, right? Basically the cost of money is the foundation of the time value of money calculations, which are the foundation of finance. So everything builds off of interest rates in some way or another. And that's why there's so much, focus on what the Fed's doing with interest rates or where mortgage rates are, or things like that, because, those numbers have a big impact. And they're also, key to the valuation models that you use, for really all financial assets, everything from stocks, bonds, real estate, even commodities, which you wouldn't think just, barrel of oil or something like that. But the way that it's traded, interest rates have a big impact. But one of the things with interest rates is where it gets a lot of attention. I think the thing that gets less attention that is also really important are yield spreads. And so this is basically comparing one interest rate to another so that you can determine the relationship between those different rates and monitor it over time. And it can give you, insight into where the market's going or what investors are thinking about different areas of the market. You can see trends showing up that maybe haven't shown up in other economic data yet.
Yeah. So what are some of the most important things to understand about yield spreads that may offer insight into, say, future markets and so on?
Yeah, so there's a couple of them that we highlighted here, and bringing up this topic obviously because what they're showing is kind of interesting. So one interesting yield spread, that offers some insights into future markets or future inflation rates is looking at the 5-year break-even inflation rate. So that's basically taking nominal treasuries, right? So a normal 5-year U.S. government bond where you buy the bond, it pays you income. You compare the interest rate that's being paid on those bonds to the interest rate that's being paid on 5-year treasury inflation protected securities, or otherwise called TIPS. So with TIPS, the difference is you get paid a much smaller interest rate, but your rate of return is whatever the actual rate of inflation is in the future, plus a smaller interest rate. Now, in theory, an investor, they could care less. They want the highest return, right? But with arbitrage, these markets should be priced the same so that whatever the 5-year nominal rate is should be investors' best guess of what the interest rate is that will equal the TIPS inflation plus the interest rate. So if you compare the two, or basically look at the 5-year inflation break even, which can be a really strong indicator of directional moves in inflation, but where the market is pricing in terms of what investor expectations are, and also really probably one of your best forecasting tools. There are no perfect forecasting tools because the future is inherently uncertain. But in this case, using wisdom of the crowds and how these things are these investments are priced to get a better indication than probably any one person can come up with on their own.
Yeah, well, as highlighted here, it's and you shared there as well, indicator, not predictor.
Right. Of financial analysis, right? That's where, you're going through and each data point is a tile. And as you put these tiles together, it starts to create a picture, right? And so this is just one of those data points that can be useful, but you don't want to put too much weight in it. In fact, we'll kind of cover one that ended up not being so useful recently in the next segment. But with tips, it is pretty interesting. I mean, obviously, we've seen inflation go up, right? We've seen this cost push inflation from higher commodity prices, specifically oil. So what is the market pricing it? Well, the 5-year inflation break-even rate increased from 2.22% in late 2005 to 2.66% currently. So in other words, the market is priced in an average higher inflation of roughly 0.5% per year over the next 5 years. Or another way to look at it is the market is saying that it thinks prices will be 2.2% higher after 5 years than it was predicting previously. So clearly a shift up. That's not huge in terms of a year over year, but cumulative is significant.
In addition to that, is there another yield curve spread that is worth monitoring at this time?
Yeah, so on the flip side, right, the inflation spread is looking somewhat negative, signaling higher inflation. But there's another important one that we look at that's showing some positive signals. And so basically, this is the spread between 10-year Treasury bonds, often Treasury considered to be the risk-free rate over a given time period, and interest rates that are paid out by 10-year bonds that are rated triple B. Now, why triple B? It's basically the lowest credit rating that's still considered high quality or investment grade, right? If you go down to double B, that's when it crosses the line and is now considered high yield or junk. So we're looking at the spread between the highest of the high, credit rated, that's still considered to be a good, fairly safe investment, and the lowest end of that kind of safe investment category. And what we see is when investors are concerned about the future economic climate, they demand a higher yield, right? A higher yield spread to compensate for the higher risk of taking on a lower credit bond. But when concerns about economic risk are low, they may accept a much smaller premium over treasuries to compensate for the higher risk because they expect that risk won't materialize. They expect that those bonds are going to be paid off because the economy is fairly strong. So what we're seeing is currently the Treasury to triple B rated bond spread has been falling, which is basically signaling expectations for strong economic growth, strong earnings, just overall positive investment climate. The yield spread started the year at 1.76% and it's currently at 1.59%. So it's come down, although it's kind of been up and down this year. But the key is that really both of those levels are considered low. That those are pretty low spreads indicating a positive environment. And really, historically, historically, investors wouldn't be concerned until that yield spread is getting close to 3% or over 3%, which might be signaling, the higher risk of a recession.
Yeah. So overall, what are these numbers indicating? Are we looking at potentially higher inflation? That obviously that potential signal to a recession. Are we looking historically? This isn't totally abnormal, or?
Yeah, but bond market signaling higher inflation, although still fairly modestly. I think what we're seeing is the market is expecting higher inflation in the short term of that 5-year time horizon, but that it'll moderate after that, right? So more of an inflationary shock as opposed to a longer term inflationary trend. But that does represent, somewhat increase in risk. But then on the flip side, with the Treasury to triple B rated bond spreads so tight, so minimal, the market's signaling that the challenges in the oil market, the slightly higher inflation pressures is unlikely to knock the economy off its current trajectory, unlikely to negatively affect economic growth or corporate earnings and revenues and cash flows and things like that.
All right. Anything you want to add before we jump to the next topic?
Well, I would just say that, yield spreads don't always get it right, which we'll talk about right here. It's kind of interesting. We led with some interesting yield spreads that we were seeing, and then one that had been a very reliable indicator that maybe was just wrong this time.
Yeah, well, let's dive into it. Did the yield curve get it wrong? 2 years ago, the Federal Reserve yield curve recession indicator was one of the most cited data points among those calling for a U.S. recession, which we spoke about. So how has it maybe gotten it wrong? Because this is something that has been used for quite a while. I mean, decades at this point.
Yeah, and this really, I think is a great example of the importance of the mosaic approach, right? When you read the paper, they're going to tend to point out extremes. Anytime there's extreme data, whether it's really good or really bad, right? Or certain indicators like this that have been reliable in the past, and they act like it's the end all be all, the only information that you need to make decisions. But even if you have a indicator that's been very accurate, if you don't have confirming data, you should take it with a grain of salt. And this is a great example. As you said, we've talked about this in the past, but basically we'll kind of start with the Federal Reserve yield curve recession indicator. It measures the difference between short-term interest rates and long-term interest rates. So specifically, this is the spread between 3-month Treasury bills and 10-year Treasury bond yields. Now, when the spread between them gets very narrow, or especially if it goes negative, meaning shorter term rates are actually higher than longer term rates, that's often a sign that there's a recession right around the corner. And we saw that happen several years ago, where the yield curve really flattened, actually inverted, and at the peak, the recession indicator was predicting a 60% probability of a recession within the next year. Mm-hmm. And in the past, when we've seen a probability that high, it has led to a recession. Pretty much every cycle since 1960, it's called accurately. But we've seen the yield curve moderate or normalize recently. And we haven't seen that recession. And now, here we are sitting, the recession probability is at just 15% probability there'll be a recession within the next year. So it's looking like we may have gotten through that cycle of inverted or flat yield curves without it actually leading to a recession this time.
Yeah, it's really quite fascinating. But as you often speak to here is you've got to, and you did state, you've got to use more than one tool. But we get that headline, so it's easy for someone like myself, a lay person, to take it with as truth and put a little too much weight into it sometime without understanding the overall actual picture.
Yeah, and I think we have to realize there may be some differences that need to be taken into account as well, right? After the financial crisis, the Fed didn't just lower their short-term interest rate benchmark, but they engaged in quantitative easing, where they were buying bonds out further on the curve, right? So not just trying to manipulate the very short-term interest rates, but trying to manipulate longer-term interest rates. And we saw similar activity during COVID, when
Right.
Really the federal government, the Fed, was all were coordinating to kind of pull out all the stops to support the economy until things could normalize. And so it could be that that type of behavior is really changing the landscape and making this type of tool less valuable, right? Which those things can happen over time. We've talked about the challenges with survey data that we've been dealing with recently, where surveys like consumer confidence that used to be useful have really been showing the opposite of what they should be showing, given what's actually happened. And I think that's, because we've seen these kind of societal shifts or shifts in how the data collection is done. And in this case, with the yield curve recession indicator, it may be that it was just a shift in Fed policy and how they were implementing it that made that has made that tool less effective. So something we need to keep in mind going forward. What's the environment? Is this tool likely to be more accurate or less accurate based on other mitigating factors?
Yes, sir. All right, let's jump to trustee versus power of attorney. We've touched on each of these individually, but now it's important to take the big look at what a trustee of a trust and a power of attorney both allow individuals to manage legally and financial affairs and so on for someone. But they operate very differently and have a different scope and timeline. So a power of attorney, let's start there first and foremost.
Yeah, so a power of attorney it's basically a document that appoints an agent, right? Or sometimes that agent is called the power of attorney to manage personal assets for another individual, right? A lot of times, maybe because that person is incapacitated or just for some reason unable to manage their own affairs. So that's how you deal with things like certain bank accounts, retirement accounts, such as 401ks, IRAs, basically anything that can't be registered in the name of the trust. There has to be a document separate than the trust that allows those assets to be managed. And, you also have to take into account their bills have to be paid, right? You have to file your taxes, right? Who has authority to do that? So that's where the power of attorney kicks in, and is very important in those scenarios, but also ends at death, right? Because that is, someone who is alive has appointed someone else to act on their behalf while they are alive. Once they are no longer alive, that activity stops. Whereas a trustee, on the other hand, they're going to manage the assets that are held in the trust, right? So anything that's registered in the name of the trust is that's their responsibility, and they can also, disperse funds from the trust to help pay for bills and things like that. But really, they're managing that portion. So it's important to understand that these two pieces really go hand in glove and working together. And for most people, you need both of them, and you need them to be fairly well coordinated to handle the overall financial picture.
Yeah, is just out of my own curiosity, is there situations in which power of attorney is granted to the person who is also a trustee, or are these usually things where they're kept separate for specific reasons, especially for what you laid out there of certain things that cannot be put in a trust and things that are within a trust?
Yeah, a lot of times you see the same kind of list of people appointed, right? The first in line, second in line, third in line for both documents. And who's it easier to coordinate with than yourself versus having to coordinate with another person. But you do see times where there's specific reasons why someone may name a different person, right? And then there is that need for them to be people that can work together, because each of them is given specific authority and power over different assets and tasks, and so they really need to be able to coordinate that. And then of course the trustee is really important, because the trust and typically the trustee is the one that will be administering that trust and estate after the person's death. So what's done beforehand can affect what needs to be done after the fact when someone passes. So yeah, you need to have both. You need both documents. You need people that you trust in both. It can be one person, or you can even have two people working jointly together, right? Kind of sharing those, or it can be separate individuals in some cases, but it's important to really think through, are they going to be able to work together to, effectively and in a timely manner handle all these jobs.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We got one item pinned up there, and it looks like a good time was had.
Yeah. So Plan Solutions recently sponsored the first annual. I know, that's not technically correct from an English standpoint, because if it's the first one, you can't say it's annual, but that's what they called it. So I'm going to go with it. But it was the first annual Big Brothers Big Sisters of Sacramento golf tournament. It was hosted by former Sacramento King, All-Star, two-time All-Star Brad Miller, right? So big guy, super nice guy, and he really is passionate about Big Brothers Big Sisters. He was a little brother when he was growing up, and really credits the Big Brothers Big Sisters back in Indiana where he grew up with helping to keep his life on the right track. Actually, fascinating story. He's still good friends with his big brother from they were paired up when he was 9, and they're still great buddies and do a lot of things together. So it makes sense that that would mean a lot to him. And being his roots here in Sacramento as a former player, he's trying to help the Sacramento chapter really get up and going. So put on a golf tournament at Del Paso Country Club, and despite the really windy conditions, I had a great time. And Shannon, Candace, Carter, and Matt went out and worked a table at a hole that we sponsored, so they got to meet a lot of people and meet Brad. And Candace even got a picture with him that we put in the newsletter that is pretty amazing. Her standing next to Brad, I think she comes up to about his elbow. So we're having a debate whether Brad's really tall or she's really short, or a combination of both.
Yeah, kind of a combination of both, but too cool. I really enjoy that. That was a nice highlight to see. Anything else you want to add, Chase, while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, just as I said, I will be taking a little vacation, but I think we've got everything nailed down here at the office. And if people need any help, Daryl and Joel will be available. Of course, Shannon's always available, and even Matt and Carter, are doing a really good job with a lot of the different day-to-day tasks. So I will still be monitoring emails and things, but people should feel free to reach out to them.
Absolutely. And great way to see the picture of Candace and Brad Miller. Well, subscribe to the Personal Financial Review, the written content that we discuss here on the podcast. It's easy to do. You just email Katie, Katie, at plansolutions.com, and let her know you want to subscribe today. As well, please hit that subscribe button on whatever podcast platform you're on, Apple Podcasts, Spotify. Leave us a rating and a review, or you can go to our YouTube channel, youtube.com/@plansolutions, and you can watch along to a visual form that includes the Personal Financial Review there.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.